If you walked into your bank tomorrow and asked for a large amount of cash, not a loan, not a wire transfer, not a business transaction, just your own money, something subtle would happen. A pause, a look that lasts half a second longer than it should, maybe a question that feels strangely personal. What's it for? Where are you taking it? Do you really need that much in cash? Nothing illegal has happened, nothing suspicious has been proven, yet suddenly your money feels like it isn't entirely yours. That moment is easy to dismiss. Most people do. They laugh it off, they comply, they answer the question, they accept the delay. But that hesitation is not random. It's the first visible crack in a system that quietly changed while no one was looking. Because cash is different. Cash is the only form of money that doesn't ask permission, and that is exactly why it is being pushed to the edge of extinction. We are told this campaign against cash is about crime, about drug dealers, terrorists, tax evaders, shadowy figures moving suitcases of money through dark airports. Cash, we're told, is dirty. Cash is dangerous. Cash enables bad behavior. And for years, that story worked. It sounded reasonable, responsible, even moral. But there's a problem with it. The largest criminals on earth don't use cash anymore. They haven't for a long time. They use shell companies layered across jurisdictions, offshore accounts hidden behind legal structures, trade invoices designed to move value without ever touching paper money, complex digital transfers that bounce through compliant banks. Cartels adapted years ago. So did corrupt corporations. So did political elites. Cash is inefficient for them. It's heavy, bulky, difficult to move at scale, and increasingly easy to detect in large amounts. So if cash is no longer the tool of serious crime, why is it being treated like one? Why are high-denomination bills disappearing around the world? Why are cash transactions capped, delayed, reported, and discouraged? Why does withdrawing your own savings feel like crossing an invisible boundary? The answer isn't crime, it's control. To understand why cash has become a problem, you have to look at how modern economies actually function, not during good times, but during crises. For decades, governments relied on a simple playbook. When the economy slowed, central banks cut interest rates. Cheaper borrowing encouraged spending, spending stimulated growth, growth stabilized debt. The formula worked until it didn't. Each crisis required deeper cuts than the one before it, and after every rescue, rates never fully recovered. They stayed lower, until eventually central banks ran into a limit they don't like to discuss publicly, a mathematical wall. It's called the zero lower bound. At its core, the idea is simple. If interest rates fall to zero, cutting them stops working. Why? Because people always have an alternative. Cash. A bill in your pocket doesn't earn interest, but it also doesn't lose value. Zero may not be exciting, but it's better than negative. And that option is dangerous for policymakers. Because the moment interest rates go below zero, people begin asking a very basic question. Why am I paying the bank to hold my money? And if enough people ask that question at the same time, the system starts to fracture. Banks don't keep your money in a vault. They lend it. They invest it. They rely on the assumption that most people won't demand it all at once. If millions do, the illusion breaks. And when confidence breaks, bank runs follow, fast. This is the scenario central planners fear most, because as long as physical cash exists, there is a limit to how far policy can go. Cash is an escape hatch, a silent veto, a way to step outside the system when the rules become unfavorable. And from the perspective of those managing debt-heavy economies, that freedom is a liability. In academic circles, this isn't controversial. It's acknowledged openly. For years, influential economists have argued that cash limits monetary policy, not because it enables crime, but because it enables choice. If people can avoid negative interest rates by holding paper money, negative rates lose their power. And that power matters more today than ever before, because global debt has reached historic levels. Governments owe far more than they can realistically repay through taxes alone. Inflation helps reduce that burden. Low interest rates help keep payments manageable. But eventually, even that isn't enough. At that point, the only option left is financial repression, a quiet transfer of wealth from savers to debtors, a system where money slowly loses value unless it's spent or invested in ways the system prefers. Cash gets in the way of that. So the war on cash doesn't begin with bans. It begins with inconvenience. Withdrawal limits, reporting thresholds, delays, extra questions, suspicion. Cash-only businesses are framed as outdated or risky. Cash users are portrayed as paranoid or irresponsible. The goal isn't to outlaw cash overnight. It's to make opting out feel abnormal. Because once people accept that money should be traceable, permissioned, and reversible, the next step becomes possible. Replacing it. Not with freedom-enhancing technology, not with decentralized systems, but with something far more powerful. Money that can be watched, adjusted, directed, and eventually programmed. That's where this story is going. And once you see where the road ends, the early warning signs start to look very different. Because the war on cash isn't about stopping criminals, it's about removing the last exit before the rules change. There's a reason this pressure against cash is accelerating now, not decades ago. And it has nothing to do with technology finally catching up. It has everything to do with debt. Modern governments are drowning in it. Not just a little more than usual, not just temporarily, historically unprecedented levels. For years, debt didn't feel dangerous because interest rates were falling. Borrowing was cheap, payments were manageable. Growth, or at least asset inflation, papered over the cracks. But debt doesn't disappear, it accumulates, and eventually the math stops working. Governments can't raise taxes indefinitely without backlash. They can't cut spending without destabilizing the system they depend on. An outright default is politically unthinkable. So they reach for the option that's least visible. Make money worth less over time. This is where monetary policy quietly turns coercive. In theory, interest rates are supposed to reward saving and discipline borrowing. In practice, they've become a control mechanism. When rates are positive, people have choices. Save, wait, delay spending, protect purchasing power. But when rates approach zero, those choices narrow. And when rates go negative, they disappear. Negative interest rates flip the logic of money on its head. Instead of earning for patience, money punishes it. You are no longer rewarded for saving. You are penalized for not spending. At first, it sounds mild, a fraction of a percent, barely noticeable. But multiplied across millions of people and trillions of dollars, it becomes one of the largest wealth transfers in history. From savers to borrowers, from households to governments, from individuals to the system. And it only works if escape is impossible. This is where cash becomes a problem. As long as cash exists, negative rates have a ceiling because people always have a choice. They can withdraw their money, store it, accept 0 instead of -2. That option alone neutralizes the policy. So, from a central planner's perspective, cash isn't just inconvenient, it's insubordinate. It undermines the ability to force behavior during a crisis. That's why, in economic literature, cash is often described as a constraint, not a feature, a bug. Something that prevents policy from going as far as planners would like. And when a system views something as a constraint, the instinct isn't to coexist with it, it's to remove it. This is the part most people miss. The war on cash isn't driven by malice, it's driven by incentives. When debt reaches extreme levels, governments need citizens to behave in very specific ways. They need spending, not saving, compliance, not hesitation, participation, not optionality. Cash allows people to quietly refuse. They can hold back, they can wait, they can exit temporarily without protest. Digital systems don't allow that. They record, they respond, they enforce. And once enforcement is automated, resistance doesn't need to be crushed. It just needs to be made uncomfortable. This is why the push against cash begins gently. No bans, no announcements, no dramatic speeches, just friction. A few extra questions, lower withdrawal limits, longer delays, more paperwork. Each step feels reasonable on its own, but together they change behavior. People stop using cash not because they're forced to, but because it becomes annoying. And once usage drops low enough, the argument flips. Why do we even need this anymore? At that point, removal feels logical, even inevitable. This is also why discussions about digital replacements are framed so carefully. They're not presented as tools of control. They're marketed as upgrades, faster payments, lower costs, financial inclusion, security. All real benefits, all incomplete truths.
Because what's never emphasized is what's lost. Anonymity, finality, autonomy, the ability to transact without approval. Once money becomes purely digital, it stops being a neutral medium. It becomes a managed system. Rules can be added, limits can be adjusted, conditions can be imposed, and those changes don't require new laws, they require updates. Supporters argue that these tools will only be used responsibly, that safeguards will exist, that democracies won't abuse this power. But history suggests otherwise. Power doesn't need bad intentions to cause harm. It only needs stress, and stress is guaranteed. Recessions, crises, emergencies, political instability. Every system eventually faces moments where normal rules feel insufficient. And systems built for control rarely choose restraint when pressure rises. This is where the conversation shifts from economics to something deeper. Because once money becomes programmable, it stops being just money. It becomes policy. Imagine stimulus that expires if not spent fast enough. Imagine savings that decay if held too long. Imagine transactions blocked because they conflict with broader objectives. None of this requires authoritarianism. It only requires priorities, and priorities change. This is why cash matters, even if you personally prefer digital payments. It's not about how you pay today. It's about what exists as a backstop. Cash is a release valve. It slows things down. It limits extremes. It gives individuals time and space when systems overreach. Remove it, and everything becomes immediate. Policy transmits instantly. Mistakes propagate faster. Corrections become harsher. There's no buffer, no pause, no exit. And once that exit is gone, behavior changes permanently. People don't resist loudly. They adapt quietly. They self-censor spending. They avoid risk. They comply preemptively. Not because they're ordered to, but because the system rewards obedience and punishes deviation automatically. That's the real power of a cashless structure. Not surveillance, but leverage. The war on cash at its core is about removing unpredictability from human behavior. Cash allows people to act independently, to organize informally, to survive temporarily outside formal systems. That unpredictability is dangerous to debt-heavy, centralized structures, so it must be managed.
then minimized, then eliminated. And it always happens under the banner of efficiency. The irony is that the harder this push becomes, the more revealing it is. If cash were truly obsolete, it wouldn't need to be pressured out of existence. It would fade on its own. But it hasn't. Because beneath all the apps and convenience, cash still represents something irreplaceable, a choice. And systems built on control can tolerate many things, but not that. For most of modern history, money had one defining feature. It was neutral. If you had it, you could use it. What you believed didn't matter. Who you supported didn't matter. What you said didn't matter. A $20 bill didn't care. It didn't ask questions. It didn't log your behavior. It didn't judge intent. That neutrality wasn't an accident. It was a stabilizing force. Because when money is neutral, disagreements stay political. They stay social. They stay debatable. They don't become existential. That neutrality is disappearing. Not all at once, not officially, but functionally. Because digital money is not neutral by default. It is conditional. Every digital transaction passes through systems owned, regulated, or influenced by institutions with incentives, policies, and risk thresholds. And those systems care very much about who you are. This is where the war on cash intersects with power in a way that's harder to ignore. Because once money becomes permission-based, control no longer requires laws. It doesn't require arrests. It doesn't require courts. It doesn't require public debate. It requires compliance from intermediaries, and intermediaries respond to pressure quietly. This dynamic has already been tested, not as a theory, as a process. Years before anyone talked openly about cashless societies, governments discovered something important. If you pressure banks instead of citizens, you can shape behavior without visible force. Accounts don't need to be seized. Businesses don't need to be outlawed. People don't need to be charged with crimes. They just need to be cut off. From payments, from processing, from access. The result is the same: economic suffocation. What makes this approach powerful is that it leaves no fingerprints, no dramatic announcement, no controversial legislation, just risk management, just terms of service, just compliance. And because the pressure flows indirectly, responsibility is diffuse. Banks blame regulators, platforms blame banks, officials deny involvement. Meanwhile, lives are disrupted quietly. This was the moment when money stopped being just a medium of exchange and started becoming a tool of governance. The next phase made this power visible to everyone, not in theory, not in academic papers, but in real time. People watched as ordinary citizens lost access to their finances overnight, not because they were convicted of crimes, but because of association, because of participation, because of belief. The shock wasn't just political, it was psychological, because it revealed something most people had never considered. Digital money doesn't belong to you in the same way cash does. It can be paused, frozen, reversed, and it can happen without warning. This is where the illusion broke. The illusion that digital money is simply a faster, cleaner version of cash. It isn't. It's a fundamentally different thing. Cash is possession. Digital money is access, and access can be revoked. Once people see that distinction, the implications multiply. If accounts can be frozen for one reason, they can be frozen for others. If transactions can be blocked in emergencies, emergencies can be redefined. If financial access depends on behavior, behavior becomes regulated indirectly, not through force, through friction. This is how control scales in modern systems, not by confrontation, but by dependency. People don't need to be punished publicly. They just need to feel the cost of non-compliance privately. A declined payment, a delayed transfer, an unexplained restriction. Enough inconvenience and most people adjust, not because they agree, but because survival requires participation. This is why cash is uniquely dangerous to centralized systems. It allows economic activity without oversight. It allows coordination without approval. It allows dissent without confrontation. You don't need to protest loudly if you can quietly opt out. And that quiet opt-out is intolerable in systems built around predictability. This is also why the move toward cashless systems is often justified in moral terms: safety, security, stability. The argument is always that the power will only be used against the bad, but the definition of bad is not fixed. It shifts with elections, with crises, with narratives. What's unacceptable today was protected yesterday, and what's protected today may be unacceptable tomorrow. The danger isn't that this power exists, it's that once it exists, it will be normalized, and once normalized, it will expand. Because every crisis creates justification, every emergency creates precedent, and systems rarely surrender power voluntarily once they've tasted its efficiency. This is the deeper reason the war on cash matters, not because everyone will be targeted, but because anyone could be. And when money becomes conditional, neutrality disappears, participation becomes contingent, and silence becomes safer than dissent. This doesn't require authoritarianism. It doesn't require conspiracy. It only requires alignment between incentives and capability. Digital systems reward control. Debt rewards compliance. Crises reward speed over debate. And cash slows all of that down, which is why it must be framed as obsolete. The final step in this transition isn't banning cash, it's redefining money itself, from something you own to something you're allowed to use. And once that shift is complete, power no longer needs to announce itself. It operates automatically, quietly, through systems people depend on too much to question. This is why the war on cash is not just an economic story. It's a story about leverage, about who gets to decide the terms of participation in society, about whether disagreement remains a right or becomes a liability. And this is where the narrative is headed next, because once control over money is centralized, the temptation to refine it becomes irresistible. Which brings us to the next stage, programmable money. And the moment when money stops responding to people, and people start responding to money. Once money becomes fully digital, something subtle but profound happens. It stops being passive. Cash doesn't care how it's used. It doesn't react. It doesn't adapt. Digital money does. And when that digital money is issued directly by a central authority, its behavior can be shaped intentionally. This is what's meant by programmable money, not in the abstract, in practice. Supporters describe it as an upgrade, money that moves faster, money that costs less to manage, money that integrates seamlessly with modern life. But programmability isn't about speed, it's about rules. Because once money is software, rules can be embedded directly into it. Rules about when it can be spent, where it can be spent, how long it remains valid, what conditions must be met before it works. At that point, money is no longer neutral, it becomes conditional. This is the logic behind central bank digital currencies. They're often presented as a digital version of existing money, but that comparison is misleading. A digital balance at a commercial bank is still mediated through private institutions. It's constrained by contracts, competition, and fragmentation. A central bank digital currency is different. It's issued directly by the state, which means the same authority that sets monetary policy also controls the ledger. The same institution that responds to crises also defines the rules. And those rules can change instantly. This is where theory met reality, because this future wasn't just imagined, it was tested, quietly at first, then forcefully, and the results were impossible to ignore. A few years ago, a large country decided to move ahead of the rest of the world. Its leaders announced the launch of a brand new digital currency issued directly by the central bank. The messaging was optimistic: modernization, inclusion, efficiency, a leap into the future. The technology worked, the infrastructure was built, the app was launched, and the public didn't care. Adoption was almost non-existent. People continued using cash, not because they were anti-technology, but because cash worked. It didn't crash, it didn't require updates, it didn't depend on trust in institutions that had failed before. Cash didn't ask permission. When persuasion failed, the strategy changed. Instead of convincing people to adopt the digital system, the alternative was removed. Physical currency was redesigned. Old bills were declared invalid. Citizens were given a short window to exchange them for new notes. On paper, it looked orderly. In reality, something critical was missing: enough cash. Banks didn't have sufficient new bills. ATMs ran dry. Withdrawal limits were imposed. People stood in lines for hours, sometimes days, just to access their own money. The economy didn't slow, it froze. Markets that depended on cash stopped functioning. Farmers couldn't sell produce, small businesses couldn't pay workers, families couldn't buy essentials. Money existed, but it wasn't usable. And that distinction matters more than people realize. Because money that exists but doesn't function is worse than no money at all. It creates panic. Protests followed, then unrest. Banks were attacked. ATMs were destroyed. Trust evaporated. The digital currency adoption rate barely moved. People didn't migrate to the new system. They resisted it. Not because they were irrational, but because they understood something fundamental. A system that can be turned off is not money, it's access. Eventually, the policy was partially reversed. Cash returned. Quietly, without ceremony. The experiment had failed. But the lesson wasn't abandoned. It was absorbed, refined. The takeaway wasn't that programmable money doesn't work. It was that forcing it too quickly creates backlash. Next time, the transition would need to be smoother, less visible, more gradual. This is where things become concerning, because the failure wasn't technological, it was psychological. People didn't trust the system. So the solution isn't to abandon the idea, it's to condition trust over time. That's why the push toward digital money elsewhere looks different. No sudden invalidation, no overnight deadlines, just nudges, incentives, convenience. Cash accepted less often, digital payments rewarded, physical infrastructure slowly dismantled, until one day cash still exists, but barely works.
And by then, resistance feels pointless. This is how transitions succeed. Not through force, through normalization. Programmability is the final piece, because once money operates through rules, those rules can serve any objective: economic stimulus, inflation control, public health, environmental targets, social stability. Each goal sounds reasonable on its own, but once enforcement is automated, there's no distinction between encouragement and compulsion. Imagine stimulus that expires if not spent quickly. Imagine travel funds that work only within certain regions. Imagine spending limits adjusted dynamically based on behavior. None of this requires surveillance in the traditional sense. It only requires conditions. And conditions don't feel like oppression. They feel like friction. This is why programmable money represents a fundamental shift. In a cash-based system, money responds to people. In a programmable system, people respond to money.
Behavior adapts to rules, and rules adapt to objectives. The danger isn't that these tools exist, it's that once they exist, they will be used, not necessarily recklessly, but inevitably. Because every crisis creates justification, and systems built for emergencies don't disappear when emergencies end. The experiment showed something else, too. People don't reject control immediately, they reject dysfunction. Which means as long as systems work smoothly, the loss of autonomy can go unnoticed until it's needed, and by then, it's gone. This brings the story to its turning point, because once money becomes programmable, once cash fades into irrelevance, once exits are closed quietly rather than slammed shut, the balance between individuals and institutions changes permanently. And history suggests that when that balance shifts, it rarely shifts back without pain.